dotted line below us, around about the 85s, 86, 87s. So we're hoping to get that sweep in there. What are we looking at? Why are we looking at it? Let's take a look at the various elements that go into that as a possible trade. The first two elements that we're interested in are these two. And if we're selling the red line, we are buying oil. You can see the red line makes a higher high. The purple line makes a lower high, significantly so. So that is a possible buy trade on oil just in there. We're looking for that sweep lower. We're trying to find it. There it is there. Higher high on red line. A significant value divergence on the red line, purple line. Secondly, we're looking at the purple line, blue line divergence. When we look at the purple line, blue line divergence, the purple line should also be premiumed against the blue line. You can see the purple line is upticking, the blue line is downticking. So that gives us an idea that this is very, very definitely a sell. A sell on the purple line. This is definitely a buy on oil. We want to be in this trade. And then the very candle that we're talking about where this buy arrow is here, you'll see that the purple line actually upticks against a blue line that downticks. A very strong signal to buy oil. And the final line we look at is obviously the relationship between the blue line and the black line, which is looking at the percentage against the crack spread itself. And again, it's the same order. If you're selling the black line, you're buying oil. So you can see what happened into the low price here. There's a very substantial value divergence, black over blue, and that gives us an idea that this is definitely a buy on oil. And what happened to oil? Well, you know what happened to oil, don't you? What happened to oil? Oil prices came off that area like an absolute choo-choo train without sweeping the lower prices, without getting into that big liquidity level at the bottom edge, and it swept off the 10s and it traded 11 10s, guys. It took, well, you saw the tweet was at 328. By 338, 10 minutes later, it was trading $1,000 higher. $1,000 higher after the tweet. 10 minutes later, guys. 10 minutes. 10 minutes later. So it's just about recognizing that you're not going to get the sweep. Now, if you need the sweep, we've had this conversation with Paul on gold before. If you need the sweep because it's the only thing that makes you feel comfortable, well, you wouldn't obviously have got that trade, and you'd have had to accept that that's just one of the things, the prices you pay for getting the setup that you require as a trader. So that's what you've got to try and recognize is, if that's what I need, I can't get upset by not getting it. Understand? If that's what I need, I can't start getting upset when it doesn't give me exactly what we need. However, you're going to miss out on a lot of really, really good trades. Because you don't get the sweep, the outcome is usually better. Why is that the case? Well, you imagine that Mike's on the floor of exchange, and you imagine that Goldman's are bidding the lows. And Mike notices across the floor that Goldman's are bidding the lows at 5s and 6s. And Mike says, okay, let's see what happens. He knows that there's some buyers in at 5s and 6s as well, and he thinks to himself, you know what? I think they might run 4s and 3s. I'm going to come in at 3s and 2s. I'm going to start bidding 3s and 2s behind Goldman's. They might not cross the spreads. I'm going to be happy to bid 3s and 2s. The price trades 5s. The price trades 6s. The price trades 5s. The price trades 6s. Mike's bidding 3s and 4s. Price trades 5s. The price trades 6s. Goldman's bid 6. Goldman's bid 7. What's Mike going to do? Well, either one of two things. He's either completely missed the trade, or he's going to have to cross at 7s and 8s. He's going to have to now get in front of Goldman's at 7s and 8s and cross the spread. There's only those two choices. Now, obviously, it all depends upon what? It depends upon whether there's any value still in the trade at 7s and 8s. If you think the value is at 20, you'll pay 7s and 8s, right? If you think the value is at 30, you'll pay 7s, 8s, 10s, 12s, 15s. But if you think the value is 9s and 10s, there's no way you're going to pay 7s and 8s. So it all depends upon the value that you're seeing. If the value is really good, you should want to cross the spread, because if you cross the spread, so will everybody else. And that means you get a fast money break, because that's what happened as soon as we cleared the top edge here, isn't it? That's exactly what happened as soon as we cleared oil's top edge here. Anybody that was wearing below this area, so there's a little buy box of massive amounts of buyers in this area here, right? Big buy box here. In fact, the 109.70, 109.80 price that we'd already told you about, right? So you're already aware that there's a big buy box of buyers in this area. So obviously when the price doesn't trade in there, what happens to all these buyers? Well, all the guys that are waiting for that buy opportunity in there, every single one of those dudes hasn't been filled. Every single one of those dudes has to make a decision about how much value is in this. Now, obviously, most of those guys jump on board. Most of those guys are now chasing this market to try and get some trade on. And obviously, once the liquidity's gone, it's just a case of saying, right, it's gone, it's busted. Boom, massive upside rip. So if you got it on the bid watch, guys, if you got it on the bid watch, congratulations. Great trade, love it. If you didn't, well, that's either absolutely fine because you need it, or it's a disaster because you don't need it, in which case you should have been crossing and you should have been taking advantage of that bid watch that we'd already tweeted to you guys.